Most people think the hardest part of losing a spouse will be emotional. And of course, it is. But what almost nobody talks about is this. After one spouse passes away, many widows and widowers get hit with something unexpected, a tax increase. Even though their income goes down, and even though they're alone, and even though nothing got better, it's called the widow's tax trap. And it quietly costs retirees thousands of dollars a year if they don't see it coming. Today, I'm going to explain exactly what it is, why it happens, and what you can do now to protect yourself or the person you love. If you're near retirement and want clear, honest guidance on the financial realities nobody warns you about, make sure you hit the subscribe button down below. This channel is here to help you retire with clarity, confidence, and control. All right, let's talk about the widow's tax trap. So what is the widow's tax trap? Well, the widow's tax trap is one of the strangest and most unfair things in retirement planning. Here's the basic idea. When one spouse passes, household income often drops, one Social Security check disappears, and the survivor is living on less. But at the same time, the survivor often moves into a higher tax bracket. So you end up paying more tax on less income. That's the trap. And if it shocks people, because it does, but the problem is most retirees assume if one spouse dies, income goes down, so taxes should go down too, right? But that's not how the tax code works. Let me explain why. When a couple is married, they are filing taxes as married filing jointly. Those tax brackets are wider, the standard deduction is bigger, and the system is more forgiving. But when one spouse passes, after a short period, the surviving spouse usually files as a single. And single tax brackets are much tighter, meaning you hit higher tax rates faster. So even if your income drops, your tax rate can rise. That's the widow tax trap in one sentence. Same income streams, smaller brackets, higher taxes. Now let me give you a quick example. Let's say a couple has $120,000 of taxable income. Married filing jointly, they might be comfortably in a moderate bracket. Then one spouse passes away. Now the survivor may still have roughly $90,000 of income, but now they're filing single. That $90,000 fills up the lower brackets much faster, so the survivor pays a higher marginal rate. Same lifestyle, less income, higher taxes. That's brutal, and it happens every day. There's something called the Social Security double hit, and here's where it gets worse. Most couples in retirement have two Social Security checks. When one spouse dies, the survivor keeps the larger check, but the smaller one goes away. So income drops immediately, but here's the tax twist. Social Security can become more taxable after widowhood. Why? Because the survivor's tax bracket changes, and the formula for taxing Social Security depends on the combined income. So widows can lose one benefit check and pay more tax on what remains. That's a double hit. Now, many widows say, I thought Social Security would help stabilize things. And it does, but the tax side can surprise people. We also have something called required minimum distributions that become a problem. So let's talk about the IRAs and 401ks. When you hit your 70s, the IRS requires the withdrawals called the required minimum distributions. And for married couples, RMDs and the RMD income is spread across the joint tax brackets. But for a widow filing single, or even a single person for that matter, those same RMDs can push that person into a higher tax territory. And here's the painful part. That spouse may not even need the money, but they're forced to take it, and they're forced into a taxable income at a higher tax rate while living alone. This is one of the most common widow traps. Now, there is a widow penalty with Medicare, or IRMAA. This one is a sleeper. Medicare premiums are income-based. If your income crosses certain thresholds, you pay extra. It's called IRMAA, or Income-Related Monthly Adjustment Amount. Married couples have higher thresholds. Singles have lower thresholds. So a widow can get pushed into a higher Medicare premium bracket even if their income is lower than before, meaning higher taxes, higher Medicare costs, lower household income, all at once. Widowhood becomes a financial stress test. Now, there's also the emotional side nobody plans for. So let's pause, because this isn't just math. Widowhood is one of the hardest transitions in retirement. The survivor is dealing with grief, paperwork, loneliness, major financial decisions, and then the IRS shows up with a tax increase. It feels cruel. Most widows aren't trying to optimize taxes, they're trying to breathe. That's why planning ahead matters so much. Not to be perfect, but to reduce the burden later. So how do you avoid the widow's tax trap? We're going to go through some key strategies. And there's some good news here. There are ways to reduce this. You can't eliminate every impact, but you can plan around it. Now, here are some of the strategies. One is doing a Roth conversion while both spouses are alive. This is one of the most powerful tools because the brackets are much higher. When you're married, filing jointly, you have those wider brackets. That creates a window to convert some IRA money into Roth money at lower rates. Then later, the surviving spouse has more tax-free income, smaller required minimum distributions, and more flexibility. Roth money is a widow's best friend. Strategy 2 is coordinate Social Security with the surviving spouse. Social Security isn't just about maximizing the couple's income today. It's about protecting the survivor tomorrow. Delaying the higher earner's benefit often increases the survivor benefit later. That can be a lifeline. Strategy 3 is simplify your accounts and beneficiaries early. The best time to organize beneficiaries, account ownership, consolidation, passwords, income sources is before someone is forced to do it alone. Clarity is kindness. Strategy 4, build income that isn't all taxable IRA withdrawals. If all income comes from tax-deferred accounts, the widow will be forced into taxable distributions. Having diversified income sources help, such as having money in Roth, brokerage, dividend interest income strategies, insurance-based income, tax-managed cash flow. The goal is flexibility. Strategy 5 is plan for Medicare premium thresholds. Most people don't realize that Medicare premiums can rise sharply. Planning withdrawals and conversions around IRMAA thresholds can save you thousands of dollars. Now here's the real message and the real truth. The widow's tax trap isn't about taxes, it's about love. It's about making sure the person you care about isn't left with higher taxes, higher premiums, lower income, confusing decisions, and financial stress. During grief, most couples will face this reality eventually. The question is, will the survivor have clarity? Or will they be forced to figure it out in the hardest moment of their life? Now, let me ask you, have you and your spouse ever talked about what happens financially if one of you is no longer here? Most people avoid it, but it might be one of the most important retirement conversations you ever have. Drop a comment below, yes or not yet. And if you take one thing from today's video, let it be this. Widowhood changes taxes, widowhood changes income, widowhood changes everything. And the widow's tax trap is real, but planning ahead can reduce the burden dramatically. If you want more retirement guidance that deals with real life, not just theory, subscribe to the channel. We're here to help you retire with clarity, confidence, and control, and to protect the people you love through every stage of retirement. Thanks for watching, and I'll see you in the next video.